to know about Bitcoin ETFs. Hey everyone, and welcome back to Chat ETF. Today's topic is hotter than ever: Bitcoin ETFs. Ever heard of Bitcoin and wondered how to get involved, but the whole cryptocurrency thing seems a bit too tetchy? Well, Bitcoin ETFs might be the answer you've been looking for. In this video, we'll break down everything you need to know about Bitcoin ETFs, from what they are and how they work to the different types available, and whether they are a good fit for you. So, whether you're a seasoned investor or just starting out, this video will equip you with the knowledge to make informed decisions about Bitcoin ETFs. Stick around, hit that subscribe button, and let's dive into the world of Bitcoin ETFs. Question 1. What is a Bitcoin ETF? A Bitcoin ETF, or exchange-traded fund, is an innovative financial instrument designed to offer investors exposure to the price of Bitcoin, without the complexities of directly owning and managing the cryptocurrency itself. It operates similarly to a traditional stock or mutual fund, allowing individuals to buy and sell shares on a regulated stock exchange like the NYSE or Nasdaq. However, unlike a stock which represents ownership in a company, shares of a Bitcoin ETF represent a fractional interest in a pool of underlying assets directly or indirectly tied to the value of Bitcoin. Two primary types of Bitcoin ETFs currently exist, each offering unique characteristics and risk profiles. 1. Spot Bitcoin ETFs. These, currently unavailable in the United States as of February 2024, aim to directly track the price of Bitcoin by holding the cryptocurrency itself in secure storage. This approach seeks to offer the closest possible correlation between the ETF's share price and the underlying value of Bitcoin, making it ideal for investors seeking a straightforward way to gain exposure to the cryptocurrency's price movements. 2. Bitcoin Futures ETFs. These, currently approved and available for trading in the United States, invest in Bitcoin futures contracts, instead of directly holding the cryptocurrency. A futures contract is essentially an agreement to buy or sell Bitcoin at a predetermined price on a specific future date. While offering indirect exposure to Bitcoin, these ETFs may exhibit different price movements compared to spot Bitcoin due to the inherent nature of futures contracts and potential factors like contango or backwardation. Understanding these key differences between spot and futures-based Bitcoin ETFs is crucial for investors to make informed decisions regarding which type aligns best with their investment goals and risk tolerance. Question 2. Why invest in a Bitcoin ETF instead of directly owning Bitcoin? Several compelling reasons motivate investors to consider Bitcoin ETFs over directly owning Bitcoin. 1. Accessibility and convenience. Purchasing and managing Bitcoin often involves navigating complex cryptocurrency exchanges, setting up and securing digital wallets, and understanding technical aspects of the underlying technology. Bitcoin ETFs, on the other hand, trade on familiar stock exchanges like traditional investments, allowing individuals to buy and sell shares through their existing brokerage accounts. This streamlined process eliminates the need to delve into the intricacies of cryptocurrency infrastructure, making Bitcoin ETFs a more accessible entry point for many investors. 2. Regulation and security. The cryptocurrency market is relatively new and lacks the established regulatory frameworks governing traditional financial markets. This can create uncertainty and potential security risks for individuals venturing into directly purchasing Bitcoin. Bitcoin ETFs, however, are subject to regulations by financial authorities, offering a layer of oversight and potentially enhanced security compared to unregulated cryptocurrency exchanges. This aspect can be particularly attractive to investors seeking a more controlled and transparent environment for their investments. 3. Diversification. Including a Bitcoin ETF in a well-diversified portfolio can offer potential benefits in terms of risk management. Bitcoin exhibits significant price volatility, which can expose investors holding the cryptocurrency directly to substantial fluctuations. Allocating a portion of your portfolio to a Bitcoin ETF alongside other asset classes can help mitigate this risk by balancing the high volatility of Bitcoin with the potentially lower volatility of other investments. This diversification strategy allows investors to participate in the potential upside of Bitcoin while potentially mitigating some of the downside risks. 4. Professional management. Some Bitcoin ETFs are actively managed by experienced professionals who make strategic decisions about the underlying holdings and aim to optimize returns for investors. This can be particularly appealing to individuals who lack the expertise or time to actively manage their Bitcoin investments directly. However, it's crucial to remember that even actively managed ETFs carry inherent risks, and past performance is not necessarily indicative of future results. 5. Potential tax advantages. Depending on your specific circumstances and jurisdiction, investing in Bitcoin ETFs could offer certain tax advantages compared to directly owning Bitcoin. While both might be subject to capital gains taxes when sold at a profit, some jurisdictions might tax distributions received from Bitcoin futures ETFs, which are common as ordinary income, potentially offering a lower tax rate than the capital gains rate applicable to directly holding Bitcoin. However, it's essential to consult with a tax professional to understand the specific tax implications in your case, as regulations can vary by location. Question 3. What are the main types of Bitcoin ETFs? As of February 2024, two main types of Bitcoin ETFs exist, each offering unique characteristics and risk profiles. 1. Spot Bitcoin ETFs. Direct exposure. These ETFs, currently unavailable in the United States, seek to directly mirror the price movements of Bitcoin by holding the actual cryptocurrency in secure, institutional-grade custody. This approach aims to provide investors with the closest possible correlation between the ETF's share price and the underlying value of Bitcoin. This can be attractive to individuals seeking a straightforward way to gain exposure to Bitcoin's price movements, without the complexities of directly acquiring and managing the cryptocurrency themselves. Regulatory hurdles. However, spot Bitcoin ETFs have faced significant regulatory hurdles in the United States due to concerns regarding custody and potential manipulation. The Securities and Exchange Commission (SEC) has expressed concerns about the security of storing large amounts of Bitcoin and the potential for market manipulation in a relatively new and volatile asset class. As of February 2024, several applications for spot Bitcoin ETFs are pending approval, and their availability might change in the future, but regulatory uncertainties remain. 2. Bitcoin futures ETFs. Indirect exposure. These ETFs, currently the only type of Bitcoin ETF available in the United States, offer investors indirect exposure to Bitcoin by investing in Bitcoin futures contracts, instead of directly holding the cryptocurrency. A futures contract is an agreement between two parties to buy or sell a specific asset at a predetermined price on a specific future date. In the context of Bitcoin futures ETFs, the ETF holds contracts that obligate the counterparty to deliver Bitcoin at a future date. This indirect approach offers a regulated and potentially secure way to gain exposure to Bitcoin, but it comes with its own set of considerations. Price discrepancies. Unlike spot Bitcoin ETFs, which aim to directly track the price of Bitcoin, Bitcoin futures ETFs may exhibit different price movements compared to the underlying asset. This is due to the inherent nature of futures contracts and factors like contango or backwardation. Contango occurs when the futures price is higher than the expected spot price in the future, while backwardation is the opposite. These factors can lead to discrepancies between the price movements of Bitcoin futures and the actual price of Bitcoin, which investors should be aware of before investing in Bitcoin futures ETFs. Counterparty risk. Additionally, Bitcoin futures ETFs carry counterparty risk. This means that if the counterparty to a futures contract defaults on their obligation to deliver Bitcoin on the specified date, the ETF could incur losses, potentially impacting the value of its shares. This risk is mitigated by the fact that Bitcoin futures ETFs typically hold contracts with reputable institutions, but it's a crucial factor to consider when evaluating the potential downsides of this type of ETF. Question 4. What are the potential risks associated with investing in Bitcoin ETFs? While Bitcoin ETFs provide convenient and potentially regulated exposure to the cryptocurrency, they are not without inherent risks. Investors should be aware of these potential downsides before allocating any portion of their portfolio to Bitcoin ETFs. 1. Bitcoin price volatility. Bitcoin is renowned for its high volatility, experiencing significant price fluctuations over short periods. This translates to potential losses for investors holding Bitcoin or Bitcoin ETFs. The value of your ETF shares can experience substantial swings, and even periods of significant gains can be followed by sharp declines. 2. Regulatory uncertainty. The regulatory landscape surrounding Bitcoin and cryptocurrencies remains evolving. Changes in regulations could impact the availability and structure of Bitcoin ETFs. Regulatory hurdles, as seen with the delay of spot Bitcoin ETFs in the United States, highlight the potential uncertainties associated with this new asset class. 3. Counterparty risk. This risk is specifically relevant to Bitcoin futures ETFs. If the counterparty to a futures contract held by the ETF defaults on their obligation to deliver Bitcoin on the designated date, the ETF could incur losses, potentially impacting the value of your shares. While regulations attempt to mitigate this risk by requiring counterparties to meet certain financial requirements, it remains a factor to consider. 4. Fees and expenses. Bitcoin ETFs typically charge management fees and other operational expenses. These fees can erode returns over time, especially if held for an extended period. Comparing the expense ratios and associated fees of different Bitcoin ETFs is crucial to maximize your potential returns. 5. Limited track record. Bitcoin ETFs are a relatively new investment vehicle. This limited track record makes it challenging to accurately assess their long-term performance and potential risks compared to well-established asset classes. Investors should exercise caution and conduct thorough research before investing in an asset class with a limited history. 6. Tax implications. The tax implications of investing in Bitcoin ETFs can be complex and may vary depending on your location and specific circumstances. Consulting with a tax professional to understand the potential tax consequences of investing in Bitcoin ETFs is crucial to avoid any unexpected tax liabilities. 7. Underlying holdings. It's essential to understand the underlying holdings of a Bitcoin ETF before investing. As discussed earlier, spot and futures-based ETFs offer different exposures and carry unique risks. Carefully evaluate whether the ETF holds physical Bitcoin or futures contracts, as this will significantly impact your investment experience. 8. Security risks. While Bitcoin ETFs offer a potentially more regulated environment compared to directly owning Bitcoin on unregulated exchanges, they are not entirely immune to security risks. Although theft from ETFs is rare, it's vital to choose a reputable ETF provider with a strong track record of security measures in place. Question 5. How should investors evaluate Bitcoin ETFs? Before investing in a Bitcoin ETF, investors should consider several factors. 1. Define your investment goals and risk tolerance. Start by outlining your reasons for investing in Bitcoin ETFs. Are you looking for aggressive growth potential despite high risk? Do you aim for greater portfolio diversification to potentially mitigate the volatility of traditional assets? Or perhaps you're simply seeking a regulated and more accessible entry point into the cryptocurrency market. Be realistic about your risk tolerance. Bitcoin ETFs, due to the volatile nature of the underlying asset, can experience significant price swings that might not be suitable for everyone. Determining your comfort level with this inherent volatility is crucial. 2. Understand the ETF's underlying holdings. Dive deep into whether the ETF directly tracks the spot price of Bitcoin, if available in your location, or relies on futures contracts. This distinction has significant implications for price movements and potential risk profiles. For Bitcoin futures ETFs, analyze the specific contracts employed. Short-term contracts might exacerbate volatility, while longer-term contracts can be influenced by market expectations for Bitcoin's future price and create deviations from the current spot price. 3. Scrutinize fees and expenses. Actively compare expense ratios, trading commissions, and other associated fees among different ETFs. Remember, even seemingly small differences in fees compound over time, impacting long-term returns. Consider low-cost index ETF options if your goal is to passively track Bitcoin performance, as they tend to have lower fees than actively managed ETFs that might try to outperform the market. 4. Examine the ETF's trading history, if available. Focus on both volatility and tracking performance. How volatile has the ETF's price been compared to the underlying spot Bitcoin price, or its intended futures contracts? Oh, are you comfortable with the historical price fluctuations? Oh, has there been any significant tracking error, indicating how closely the ETF mirrors the underlying asset? If the ETF is relatively new, a lack of extended trading history is normal. In this case, pay close attention to the type of underlying holdings to understand potential risk profiles. 5. Research the ETF provider. Investigate the reputation and credibility of the ETF provider. Look for a company with extensive experience in financial products, a commitment to transparent operations, and robust security protocols in place to safeguard the underlying Bitcoin holdings or futures contracts. 6. Consider regulatory framework here. Stay informed about the current and evolving regulatory landscape surrounding Bitcoin ETFs in your jurisdiction. Assess how regulations governing areas like taxation and investor protection might affect your investment decisions. Be aware of potential obstacles like delayed ETF approvals or stricter rulings that might impact the availability or structure of Bitcoin ETFs. 7. Tax implications. Consulting with a tax advisor is crucial to understand how investing in Bitcoin ETFs will fit into your overall tax strategy. Proactive planning helps avoid unexpected liabilities and ensures you get the most favorable tax treatment possible based on your unique circumstances. Question 6. Are Bitcoin ETFs a good investment for everyone? Here's an in-depth analysis of who should and should not consider investing in Bitcoin ETFs. Suitable investors. 1. High risk tolerance. Individuals who are comfortable with significant volatility and potential for large losses can potentially consider Bitcoin ETFs. The inherent volatility of Bitcoin translates to potential fluctuations in the value of the ETF, requiring investors to be prepared for a rollercoaster ride. 2. Understanding of the underlying technology. A basic understanding of blockchain technology and the risks associated with cryptocurrencies is crucial before investing in Bitcoin ETFs. This knowledge allows investors to make informed decisions based on a more comprehensive picture of the underlying asset and its ecosystem. 3. Diversification goals. Including Bitcoin ETFs in a well-diversified portfolio can offer potential benefits in terms of risk management. Bitcoin's diversification potential stems from its low correlation with traditional asset classes like stocks and bonds. However, diversification does not guarantee positive returns or eliminate risk. Unsuitable investors. 1. Low risk tolerance. Individuals with a low tolerance for risk should avoid Bitcoin ETFs. The high volatility associated with this asset class can be extremely stressful and lead to impulsive decision-making, potentially causing significant financial losses. 2. Limited knowledge. Individuals with limited understanding of blockchain technology, cryptocurrencies, and the associated risks should approach Bitcoin ETFs with caution. Investing without sufficient knowledge can lead to poor investment decisions and potentially detrimental financial consequences. 3. Investment reliance. Bitcoin ETFs are not suitable for individuals who depend on their investment returns to meet essential financial needs. The volatile nature of this asset class can lead to significant fluctuations, potentially jeopardizing your financial stability.